While this was not the first explanation video I was hoping to do, here we are. My name is Thomas, and this is For the Common, a channel on YouTube that's focused on arming everyday investors like you and like me with the information and the tools that we need to be successful. Thank you so much for checking us out. Hopefully you'll find the video helpful. So in my last portfolio reveal video, I talked a ton about margin. Margin is this fancy finance topic. It's complex, it's scary, but it's the number one reason why my portfolio over the last 3 months has been feeling a ton of pain. It's been absolutely brutal. So with this video, I'm hoping that I can help somebody else out there who's either trying to learn about margin, maybe struggling with margin, learn from my mistakes. And as well, this video is going to be an awesome reminder for me down the road of the pain that I'm feeling today, and will hopefully keep me disciplined when using margin in my account in the future. So again, in this video, we're going to cover what is margin, what are some of the cons of margin, because there are plenty, but also what are some of the pros of using margin. And as well, I'm going to talk about the lessons that I've learned using margin over the last 6 years of managing my own account. But first, very, very importantly, this is by no means a recommendation to use margin. Actually, you shouldn't use margin. Margin is really, really scary. It's complex, and it can get very painful very quickly. Margin should be saved for the most experienced investors, and investing already is a really hard game. It's really hard, and margin takes that game that's hard from normal mode to legendary difficulty, and it can be very, very brutal. So be careful with margin. I'm not recommending you use it. Just because I use margin doesn't mean you should, but if you're looking to learn a little bit more, here it goes. So to begin, what's margin? Well, there are a lot of really awesome explanation videos out there that'll walk you through it with some cool graphics, more color most likely. Margin, for my quick take, is a loan that your broker will give you based on the value of your account. And what it looks like is that when you have an account with a bunch of stocks, bonds, ETFs, mutual funds, that's worth something. And your broker, for a fee, will allow you to borrow money against the value of your account. It's kind of like a house. You buy a house, you put a bunch of money into it, and it's not like there's an ATM in the center where you can just pull your money back whenever you want. But you can go to a bank, and the bank would be happy to give you a loan against the value of your house for whatever you might want to put the money towards. And a margin account is the exact same thing, but for stocks. So you can take that money out and you can put it towards a house. You can put it towards a car. You can put it towards a roof, really any expense. Or you could put that money towards buying more stock. Interesting concept, and also one that might have gotten me a bit into trouble. So now I want to dive into how margin works, and I'm going to jump over to my computer screen. And as I mentioned, margin gets really complicated really fast, but I put together a few slides to hopefully explain it, and we'll work through it. There is some math, so you'll have to bear with me on that, but really any math and finance is arithmetic, so we will all be okay. We'll work through it slowly, and we'll get through it, but fair warning on math. So as we mentioned, margin allows you to borrow against assets that you own. So let's say you have $10,000 worth of stock, but you want to take a margin loan to invest more. You can do that. So let's say you want to borrow another $5,000. So you have $10,000, what's called equity, and I know that's confusing because stocks can be called equity, but this equity is talking about the money that's in the account that's your money. So you have $10,000 to start, and that is your contribution to the account, your equity, and there's $5,000 worth of debt. So you have the $10,000 of equity, the $5,000 in debt, you have the $15,000 total portfolio value. So let's assume your stocks crush it, stocks only go up, which is totally not true, by the way. But let's say it goes up by, $3,000. Let's first take an example of no margin. So if you have that $15,000 and you add the $3,000 that you made, good job, it's now $18,000. That's a 20% return, not bad. And how that's calculated is this formula down here. It's the $18,000, which is the ending value, minus the $15,000, which is the beginning value. So 18 minus 15 is 3,000. And then you divide that by the beginning value, or 15,000, which is the 20%. If you want to do it the more fancy way, a little easier, just some algebra here where it's the 18 divided by the 15 minus 1 gives you the same number, but that's the no margin scenario. So let's throw in some margin and assume that same rising of $3,000. So remember, $10,000 is yours, or the equity, and $5,000 is the debt. Still the same $15,000, just a little different makeup. So that $15,000 rises to $18,000, and importantly, $5,000 of that $18,000 is debt, and the bank wants their money back, so you have to pay it back. So that $18,000 minus the $5,000 in debt means that the equity in the account now is $13,000. Yeah, not bad. So $13,000 in equity, where you started at $10,000, that's a 30% return. And that's ultimately how margin works, is that it amplifies your gains when you have gains, but it also amplifies your losses. So let's run through that now. So that same $15,000 with the $10,000 of equity, $5,000 in debt. Let's first take the no margin scenario. It falls by $3,000, right? Stocks suck because of inflation worry or, war. And you have that $15,000, it falls to $12,000, which is a negative 20% return. And here's the math there. When you add margin, it amplifies your losses. So you have that $10,000 in equity, the $5,000 in debt, right? $15,000 total value. The $15,000 falls to $12,000, and again, the bank wants their money back. They don't really care that you lost money, and they'll take their $5,000 back. So of that $12,000, you only have $7,000 worth of equity because $5,000 was debt, and that $10,000 of starting equity down to the $7,000 is a negative 30% return. Again, showing that margin amplifies your gains, but also your losses. That covers one of the ways that margin can be dangerous. Like we said, amplified your losses. But there are other ways that it can be very dangerous. And one of the ways is that it can be very expensive. Some brokers charge a ton for a margin loan. So we're on TD's website here, margin rate. You can go out and find this too. The rate that they charge for a margin loan for, let's say, $10,000 to $24,000 is over 9%. That is very expensive. Think about trying to take that money that you borrow and then go invest it and get better than a 9% return. That's very hard to do. Jumping to Schwab, similar margin rate here, breakdown. Again, that's going to cost you around 8%. Now, Interactive Brokers is a unique broker in the fact that their margin rates are substantially lower than peers. So the rate that they charge for anything less than $100,000 is about 1.5%. So when you think about that money that you borrow, can you do better than 1.5% by investing it in stocks? It's possible you could, but those stocks could also go down. A really important topic that I want to get into now for margin rates and ultimately the interest rate that you'll pay on your margin loan is that margin rates are actually floating rates. So what that means is that those rates will change over time depending on what's going on in the economy and the Federal Reserve and where they set interest rates. So it's important, given all this conversation recently about the Federal Reserve raising rates, margin rates are directly tied to the Federal Reserve rate, and that will cause the interest payments for margin loans to go up. So let's dive into the Interactive Brokers website and just explain it a tad more. So this BM here stands for the benchmark rate, and a bunch of different brokers have different rates, so you need to double check this, but Interactive Brokers, the benchmark rate, you can go to figure out what that is. You can see that it's BM plus 1.5% equals 1.58. So we know that BM is a very low number. It's actually 0.08. And that makes sense given the fact that rates are so low. Again, a lot of talk about that and potentially raising rates. So as the Federal Reserve decides to increase rates, this BM will actually go up. So if they raise rates by, let's say, 1% over the next year, then your margin loan will actually cost you 1 plus 1.5 or 2.5%. That's still pretty low, and you could probably invest that in the market, do decently. But what happens if they raise rates 3 or 4%? It's possible that the interest payments on your margin could be so expensive that it would be better not to have a margin loan. And if you go to these other brokers, you'll see that they also price their margin loans off of some sort of rate. So this is a base rate, they're saying at Schwab, of 6.5%. How they come up with that, I have no idea. It's very expensive, but Schwab is absolutely going to make a lot of money on anybody who decides to get a margin loan. But you see that 6.5 base rate plus the 1.825, that's how you get that effective rate of over 8% for a margin loan at Schwab. Same at TD. You'll see their base rate is 8.25. So when you add again this above the 1.25, you're going to pay over 9% for a margin loan at TD right now. And that's not including any of the future rate hikes. So keep that in mind when you're looking at different brokers. That's one of the reasons why Interactive Brokers is so unique when it comes to margin, because they generally use a very competitive benchmark rate to set their margin rates, which is why they tend to be so low. But again, check with your broker to make sure the rate is something that makes sense for you. Another way that margin can be extremely dangerous and very painful is through this concept of margin requirements. And the way to think about it is that there are rules that govern the way margin is used and how much margin you can get, but also, brokers, how much margin and when they can give you margin and when they can't. So it's very, very important to brokers because at the end of the day, they want to get their money back. And to do that, there have to be these rules in place to protect brokers and protect clients to ensure that clients aren't ultimately taking on too much debt. And these rules were so important that they're actually written by the Federal Reserve. Yes, the Federal Reserve wrote these rules called Reg T, and they apply to all margin accounts. And these are the minimum requirements. So it is really important to check with your broker to see what your broker's requirements are. But these are the minimum requirements, and I'm going to walk through them. So for the first rule 1, it's called the initial margin requirement, and it's whenever you want to buy something on margin. So the rule is that if you want to buy something, at least 50% of the value of what you want to buy has to be paid for in cash. So an example, if you take $10,000 of stock that you just have to buy, the requirement is that you have to have at least $5,000 worth of cash to be able to buy that $10,000 worth of stock. So you have $5,000 and you borrow $5,000. That's how you are able to buy the full $10,000 worth of stock. Another way to think about it is that if you have $5,000 worth of cash, you can borrow another $5,000 to then buy the $10,000 that you want. And that's an important rule, but the most important one when it comes to using a margin account is this maintenance margin requirement. And this can lead to the dreaded margin call that you've probably heard about. And it's a minimum amount of equity that must be in the account to stay compliant. And again, the minimum that the Federal Reserve has set is 25%. So let me walk through an example. It'll make more sense. But if we go back to that, $10,000 worth of equity plus the $5,000 worth of debt, that's the $15,000 total account value. We've been using this example, throughout the video. And the requirement would state that you need at least 25% of this $15,000 in equity, or the minimum requirement is $3,750 in, equity is what you have to have in the account. Well, right now, we just outlined there's $10,000 of equity in the account, and so we're well above the minimum, and we're good. But that's assuming that there was no stock price fluctuations. So let's assume that our stocks get crushed, and let's see if we get margin called. So in the first example, using that same, $10,000 worth of equity and $5,000 worth of debt, let's assume that the stocks that we own fall 50%. Ouch, 50, that's a huge move. So that $15,000 falls 50% to now equal $7,500 in total account value. So that Federal Reserve requirement for a maintenance margin is that 25%. Are we going to get a margin call? Let's see. So 25% of $7,500 is $1,875. That's the minimum equity we have to have. So our total account value now is $7,500. You subtract out the debt that we borrowed because the broker wants to get paid back, and the equity that we have in the account after the stocks have fallen 50% is $2,500. Phew, $2,500 is greater than $1,875, not by a lot, but you are still okay. Now, let's say instead the stocks fell 60%. You can see what we're doing here. We'll go through it quickly. So $15,000 falling 60% is now equal $6,000 in total account value. If you multiply that 25% maintenance margin requirement times $6,000, it means you have to have $1,500 in equity in the account. That's the minimum. But our total account value is only $6,000, and we have $5,000 worth of debt. So when you subtract that $5,000 from the $6,000, you only have the remainder of $1,000 in equity, and $1,000 of equity is less than the requirement of $1,500, which means you get a margin call. And these rules are enforced, and they can make you do some really crazy things when you don't want to. And what I mean by that is that if in this example you were below the requirement, your broker will sell stock on your behalf to make sure that you can boost your equity to meet that $1,500 requirement. And again, complicated, but stating that the broker will enforce these rules and can make you do crazy things like sell your stock when they're down 60% to make sure that you meet the Federal Reserve requirements. So when you're trying to keep all those numbers straight in your head and you're watching your stocks fall 60% and you want to make sure you're not going to get a margin call, it is a lot to process and it can be very stressful. And because of that, margin really messes with your investor psychology, which is another way that margin is extremely dangerous. Because if stocks fall 60%, every textbook is going to tell you got to go out and buy the dip. But when you have margin and you've already borrowed money to invest in more stocks, when stocks fall substantially, as we just showed, you get closer to breaking that Federal Reserve rule around a maintenance margin, and that means you have a higher chance of potentially getting a margin call. So when you have that big downdraft in stocks, you're probably not going to be buying because, again, that psychology, it makes it very challenging to buy stocks on the way down when you have a margin account. So you're thinking through all of those different dangers and you're saying, wow, how can margin be worth it? And it's a good point, and you have to make the decision that's right for you, but there are some positives to using margin, and I'm going to highlight them now. And we've already highlighted some of them, that margin allows you to potentially boost your returns. And with Interactive Brokers, for example, I can borrow money and it only costs me 1% or 1.5% per year to borrow that money. So can I take money from Interactive Brokers, invest it in the stock market, and do better than 1%? Most likely. Stocks over the long term, their return annualized is about 6 or 7%. So that's a pretty good spread. If it costs me 1 and I make 6, that means I get to keep that extra 5%. And that's, with margin, you can borrow quite a bit of money. It can be extremely powerful. Another positive is that margin allows you to take money and borrow money out of your account without actually having to sell stock, which again is really powerful. So for example, Tesla, if you owned it and it did extremely well and you've made a ton of money, you can actually borrow against that Tesla position and you don't have to sell any shares, but you could take $10,000 out of that and invest it in another company, let's say Disney. So it allows you to diversify if you wanted to away from a stock that's doing very well, and also allows you to maybe take some of that money out of Tesla and pay an expense like a new roof if you needed to, or something of that sort. So that is another really powerful thing, is that you can access some of your capital without ultimately having to sell stock. So what have I learned over the last 6 years of investing with a margin account? There's been so many successes, but also a lot of failures. And hopefully these takeaways will be helpful for you to keep in mind if you decide to use margin in your own account. And number one is that margin is a very powerful tool. It's extremely helpful as an investor, but it can also be very dangerous. And it is very easy to get enticed by that big number the broker is willing to lend you. And there are so many great companies out there. You'll be tempted to buy those shares with the margin loan. But remember that things can change very quickly and sentiment can shift and stocks can hit rough patches quite quickly. And unless you're extremely nimble with your margin account, things can get very tough very quickly. And that leads to the second takeaway. If you're going to use margin, make sure to have a plan and stick to it. Be disciplined and set a max amount of leverage that you want to take on, and don't go above it in the good times. Because if you do, it's going to be very hard to reduce that leverage in the bad times, which is what's happening to me now. And you might be thinking, who's selling in this terrible stock market that we've had over the last 3 months? Oh, I am, because I wasn't disciplined, and margin, unfortunately, now is making me do some really crazy things like sell stocks, because that's the Federal Reserve requirement. And then the third takeaway is that if you're going to invest with margin, make sure you have a diversified portfolio, because usually when stocks hit a rough patch, not all stocks fall together. For example, right now, energy is doing extremely well. And if you own energy, those could potentially be ballast in your portfolio so that your whole portfolio isn't falling as much. But also those could be the stocks that you liquidate first if you get in a really significant margin challenged position where you have to sell stocks. So it's important to have a diversified portfolio, again, for the ballast, and as well for some liquidity if you have to decide to exit some stocks. And then finally, my fourth takeaway is that really picking quality businesses is a part of the investment challenge, but also portfolio construction is extremely difficult, and especially if you use margin. You have to be very careful about your allocation sizes. You have to really actively monitor it, and you also have to trim some positions over time to help reduce your leverage if you have too much margin. And that's something that's required to ensure that when you use margin, that you can survive some of the challenged market environments like we're having right now. Because to be able to capture the long-term benefit of margin, you have to be able to survive the bad times and be able to participate when there's a stock market rebound, which there always is. So those lessons about margin, I have absolutely learned those the hard way, 100%. And it has been a very painful couple of months. And with all that, should I just throw in the towel, call it a day, and never be an investor again? Honestly, I considered it. No, I'm kidding. No, absolutely not. Investing is all about making mistakes, learning from those, and being a better investor in the future. And I've seen the power of compounding businesses. Over the last 5 years, there were some unbelievable results that I had, and I had to learn that lesson the hard way too. I invested in bad companies and saw bad results, lost money, and learned and corrected. And in having some really significant successes over the last 5 years, I know that I'm on to something. So for this one, I'm learning the tough lesson of being disciplined, managing position sizes, and as well learning how to construct a portfolio. And that's investing. Always finding a new way to make you feel like an idiot, but that's okay. At least I can make the mistakes, and hopefully that means that you won't have to. If you're curious about my plan going forward, be sure to check out my next reveal video that highlights my portfolio and how it got absolutely crushed by margin, but also how I plan on continuing to use margin and what level of margin I think is the right amount for my account moving forward. So definitely check it out if you're interested. But again, a really important public service announcement that margin is not for everybody. And I really think it's a tool that should be reserved for the most experienced investors, because you get a lot more portfolio swings and it's pretty stressful. So again, I think it's something that should be reserved for those folks who really have a lot of experience investing. And at the end of the day, you're going to have to figure out what works for you. You'll invest, make mistakes, and learn. And, I encourage you to embrace that journey. But again, just because I'm using margin, that does not mean it's the right tool for you. So keep that in mind in your investment journey. And if you decide to use margin, just be very careful, because again, as I'm going to show in my next video, it can be extremely painful. So thank you so much for checking out the video. If you got any use from it, would really appreciate your support of the channel and a like or subscribe. So thanks again for checking it out, and I'll see you next time.